Iran accounted for 3% of global oil supplies last month. How much of that is going to be lost to the market now, do you think?
Well, it could be a lot less than people fear. S&P Global Platts analytics, we're predicting that by the fourth quarter, about 200,000 barrels a day of Iranian crude could be displaced as a consequence of that. To put that into context, that's about a quarter of what's being pumped out of the North Sea at the moment. So in a 100 million barrel a day oil market, which is what demand is expected to be this year, it's relatively small.
It doesn't seem an awful lot. So why has the oil price gone up to the extent that it has done then?
Well, that's a good question, and it's gone up because the actual market is very finely balanced. You know, the balance between supply and demand now. We've had a few years of OPEC cuts that have drained global stockpiles. That has had an effect on markets. Producers, many of them are struggling to maintain capacity. There hasn't been a lot of investment in the industry. So disruptions like this, they're not expected, and the market is very finely balanced, and that really does explain some of these price fluctuations that we've seen.
I don't suppose we're going to see any OPEC producers falling over themselves to make good this shortfall.
Well, you know, it's a market opportunity. You know, for countries like Saudi Arabia, which is the world's biggest exporter, this is an opportunity to step in and to take some of that market share. It's been fighting with Iran in the oil markets to gain a foothold, more of a foothold in crucial markets like Asia, China, and whatever barrels are lost out of Iran, you can be sure that countries like Saudi Arabia will try and step in.
All right, interesting. I mean, about 15% of Iran's output is currently bought by the Chinese. Do you think they'll carry on buying it on an under-the-counter basis?
I think it's very difficult, and the Chinese market is all important now. You look at the fundamentals of supply and demand, which we tend to concentrate on at S&P Global Platts. The Chinese market saw a 15% increase last month in imports of crude, so it's very strong demand there. They need the oil, so there is definitely an incentive for them to do that, but it's very difficult. And the way that these sanctions worked in the past, it's not so much stopping oil trades that's the problem. It's the intermediaries. It's very difficult to clear transactions. It's very difficult to clear dollar transactions. If you saw in the last round of sanctions that affected Iran, the banks, you know, a lot of them were hit very hard with penalties by the US government for doing trading in Iran in some form. So I find it very difficult to see how companies would want to take those risks.
But could this give an impetus to trade oil in other currencies, such as the renminbi or the euro?
Well, that's a very good question, and it's been talked about a long time. There's been a lot of talk historically that major oil producers would shift away from the dollar to a basket of currencies, but we live in a US dollar-denominated world. Finance is governed by the US dollar. I don't see that changing. Energy, more than anything, is very much a US dollar industry.
What about the position of Total in all this? I mean, of all the foreign oil producers, they were the ones who probably staked most on Iran being brought in out of the cold. Where does this leave them after all this?
Well, you would argue it could leave them somewhat exposed. However, they only dip their toes in the water. You know, we're talking about MOUs. It's very unclear how much actual investment they put on the ground. It was a gas development that they were looking at. Certainly, they were not alone in being amongst the international oil companies to test the waters there in Iran. I think that they should be able to extricate themselves from this if they have to. And of course, you know, they've got a quite diverse portfolio across the Middle East as well.